Hey everyone, welcome. So today we're doing a bit of a contrarian daily brief on the financial markets. It feels like everyone is getting ready for a big drop, right? Well, we're going to dig into some powerful forces that tell a very different story. Let's jump right in. So this is the million-dollar question, isn't it? With all the noise and uncertainty out there, should you just be bearish on the market? I mean, the headlines are screaming doom and gloom. The whole mood just feels heavy. But is that really the whole picture? In this explainer, we're going to push back on that idea hard. All right, here's the game plan. We'll start with why all this fear might actually be a good thing for the bulls. Then we're going to follow the money, the flow of liquidity. After that, we'll check out a pretty wild growth strategy some companies are using. Then we'll zoom out to a huge potential shift in the economy. And finally, we'll wrap it all up with what this means for you.
Okay, first things first, let's talk about this contrarian case for optimism. It kind of feels like market fear could actually be a bullish signal. Sounds weird, right? Let's break it down.
You know what I'm talking about. The big names are all over the news, warning about market drops. They're sitting on mountains of cash, and you've even got guys like Michael Burry, yeah, the big short guy, shorting major tech stocks. I mean, that's enough to make anyone a little jumpy. And look at this. The Fear and Greed Index is currently reading 21. That's not just fear, that's extreme fear among retail investors. But here's the kicker. The S&P 500 is only about 2.5% off its all-time highs. So what gives? Why is everyone so terrified when the market is doing so well? It's a huge disconnect. Well, for a contrarian investor, that disconnect is everything. They actually see a massive opportunity in all that fear. The whole idea is when everybody, and I mean everybody, is convinced the market's going down, there's nobody left to sell. The path of least resistance is up. And you know what? The charts actually seem to agree. The bullish case is still there if you look. The medium and long-term trends, they're still intact. The S&P 500 is hanging out right below its all-time highs. And hey, even the stuff that's supposed to be super weak, like Bitcoin, has had these really strong rebounds from key technical levels, like the 50-week moving average. The underlying strength just doesn't match the level of fear out there. Okay, so sentiment is one thing, but it's only part of the puzzle. There's another, much bigger driver we need to talk about: liquidity. This is the hidden force powering asset prices. If you really want to know what's going on, you've got to follow the flow. So what is market liquidity? Honestly, the best way to think about it is just fuel. It's the fuel for asset prices. When there's a ton of cash and credit just sloshing around in the financial system, that money has to find a home. And where does it go? Right into stocks, real estate, you name it. It's what pushes prices up. And here's the thing. Right now, we're seeing three key sources of new liquidity getting ready to hit. First, monetary tensions are easing up. Repo rates have fallen way down, which signals stability. Second, we're hearing the central banks signal that they're probably going to have to expand their balance sheet. And third, the Treasury is about to spend down its account, basically injecting cash straight into the system. That's a triple whammy of fuel for the market. All right, so we've got all this liquidity, this fuel. But what does that actually look like in the real world? Well, it opens the door for some really high-stakes growth strategies. Let's dive into one that's all about using leverage to snap up appreciating assets. Okay, so check out this corporate growth playbook. A company can issue low-cost debt, like bonds or maybe some shares. The point is they get a pile of cash. Then they take that cash and buy a high-growth asset, like Bitcoin. So the method is simple. Borrow cheap. The goal? Acquire something you think will grow way faster than your borrowing cost. If you're paying, say, a 12.5% yield on your debt, you're betting that the asset you bought is going to appreciate way more than that. It's a bold play for sure. But here's the core belief driving this whole thing. It's not just about one asset. It's a fundamental bet on long-term monetary debasement and fiscal indiscipline. That's a fancy way of saying they believe governments are going to keep spending like crazy, which will drive asset prices higher over time. It's a bet against cash, really. And that idea, fiscal indiscipline, leads us perfectly into our next topic, the coming economic shift. Because we might be looking at a historic stimulus aimed not at Wall Street, but squarely at the real economy. For example, there's talk of a $2,000 tax deduction, sometimes called a tariff dividend, for American taxpayers. Now, think about that. This isn't money going to bail out banks. This is money going directly into the real economy to be spent by real people. And the numbers being thrown around are just staggering. We're talking about a potential total stimulus figure of $20 trillion. $20 trillion. To put that into perspective, that is almost the size of the entire US GDP. We're talking about a truly historic amount of money. And this really shows the shift in economic focus. Past stimulus, it was all about Wall Street. It benefited financial markets. This proposed stimulus, it's all about Main Street. The goal is completely different: to relaunch the real economy. So what's the bottom line here? It's what you could call guaranteed fiscal indiscipline. It's become a bipartisan trend. It doesn't matter who's in charge. Big spending seems to be the name of the game. And for investors, that's a powerful signal that supports hard asset prices over the long haul. Okay, so let's tie all of this together. What are the key takeaways for investors? In this new paradigm, where should you even be looking for opportunity? Well, if the focus is really shifting to Main Street and reindustrializing, some potential sectors just pop right out. You've got defense and armaments, obviously, artificial intelligence, which is a massive productivity driver, and don't forget rare earth minerals. You can't build any of this new tech without them. These are the kinds of areas that could really take off. And that leaves us with the big question. In an era of what looks like guaranteed fiscal indiscipline, where will capital flow next? The old rules might not work anymore. Figuring out the answer to that question is probably the most important thing for any investor right now. Something to think about. Thanks for joining me.